good morning. It's Monday, the 16th of June, and this is Govindraj Ethiraj broadcasting and streaming weekdays from Mumbai, India's financial capital, but presently in transit. The take. A pilot friend posted on a common group saying that the verdict on how the Ahmedabad-London Air India Boeing 787 Dreamliner crashed barely a minute after takeoff is already out. That is if you were to believe the self-styled experts posting on social media or opining on television channels. Another set of pilots was convinced it was an equipment failure of some sort arising out of alleged maintenance oversight. Moreover, they believed quite strongly that the airline would try to cover it up. And by the way, the pilots who argued that Air India would cover up any organizational maintenance or related lapse were active Air India pilots. Now, there is not enough information at this point to establish what really happened on that afternoon of June 12th, 2025, on a hot Indian summer day, which caused the aircraft to fall out of the sky onto a medical college hostel near the airport. At last count, some 270 people have died in one of India's worst aviation disasters after that Boeing 787 slammed into a medical college hostel in a residential area in the northwestern part of Ahmedabad minutes after takeoff on Thursday and killed about 241 people on board and about 29 on ground. One passenger has survived. As an aside, expert YouTubers have been dissecting every bit of video and the audio they can get hold of and putting out analysis which is obviously slipstreaming into the social universe. One pilot and YouTuber who says he flies Boeing 777s concluded that pilot error was possible, but he did add that was his opinion at that point. A day later, he posted again saying that the fact that the RAM air turbine was running suggested a total power loss and thus increasing the chance of equipment failure and reducing the possibility of pilot error. And now it is also known that there was a clear mayday call referring to failure in thrust. So those are, of course, technical points. But his, and when I say his, I mean the YouTuber's disclaimers on both posts does not really matter in the larger scheme of things, as views like his coalesce into the larger whirlpool of noise around the event as expert opinion transitions into expert theory in other people's words. Media is a key culprit here. Speaking of which, Air India's CEO Campbell Wilson was reasonably quick to put out a video message to the world at large by 7 p.m. that evening, and that's reasonably quick in the context of how long top management usually takes to stand up and own up to the problem, even if the cause is not known. But the accident and the aftermath reflects the challenge Air India continues to face within 3 years after it changed owners from the Government of India to the Tatas. While most pilots are loyal to their passion and skill rather than the airline they work for, it is no secret that Air India pilots carry a level of disgruntlement higher than the average and unusual for their role in service. It's not pilots alone. Air India's toxic culture, created and nurtured in the times of government ownership, had spread to almost every department over the years. Air India had some or close to 20 unions of all shapes and sizes once, including, of course, pilots, and that too was divided into older pilots and younger pilots. Much of this has, of course, changed even as Air India has churned staff rapidly post the Tatas taking over. And this is quite evident and visible both on ground and on air in the last few years. But there are many old-timers, including pilots who've been around for a long time. And unusually, the change in ownership has not changed their view of the owner, whether government in the past or the Tatas now. It is difficult to say from the outside what drives this deep angst, except to note that it is there and at levels that are not healthy. The angst is visible within cockpits too, not in the flying of the aircraft, but in the complete silence in communication sometimes between pilots and, of course, to the passengers who are on the aircraft. I recall a JFK Delhi flight where there was not a single announcement made from the cockpit, definitely not before takeoff or before landing, when it is usually customary for captains and pilots to do so. I asked a few pilots about this particular silence, and they said that while pilots were not under any mandatory rule to speak to passengers, most did so anywhere in the world. So to come back to the culture within, the findings of the investigations will unfortunately lead to much blame being passed around. Now, this is regardless of on whom or where the hammer lands. And going by the past, expect political involvement and mud-flinging as well. So the Tatas obviously realized this and have offered 1 crore rupees ex gratia payments to the families of all those on the aircraft and killed on ground where the plane crashed. But whatever the findings, the Tatas will have to lead from the back, so to speak, and focus on the rank and file as they transition this challenging phase. The external blame game is beyond the Tata's control, but the internal drifts and stress is something that they have to get a grip on if the airline has to emerge from this unfortunate and sad phase. The handling of this will be a lesson for other businesses and business leaders and their organizations as well. And that brings us to the top stories and themes. The stock markets take a hit on the Israel-Iran war. Uncertainty returns. Oil prices zoom, a bigger concern than stock markets for India right now. The dollar strengthens even as the rupee slides. India holds back rare earth exports to Japan. And the hottest office space market in the world is
This is a core report with Govindraj Ethiraj.
The markets fall on Friday. The major indices fell on Friday and were down for the week, broadly driven by war tensions, which are, of course, back on the radar now. The markets had already turned weak on Thursday and resumed sliding on Friday, heading down as Israel continued to strike Iran and the latter retaliated. The biggest casualty was, of course, oil prices, which shot up, closing finally about 7.5% up after having gone up even further and have now crossed $74 a barrel. Iran is a big oil producer, and more on that shortly. The Nifty 50 was down about 169 points to 24,718, and the Sensex was down 573 points to 81,118 on Friday. All in all, the markets seem a little, at least at this point, resilient to what is happening around us. Oil marketing companies like BPCL and HPCL lost on worries that higher crude prices would hit refining margins. High oil prices are at this point a concern because this was one of those macroeconomic signals that was green and now is seemingly turning orange. Global equities also fell on Friday, while safe havens like gold and the Swiss franc and dollar as well gained, and more on that shortly. Israel said it struck Iranian nuclear targets to block Tehran from developing atomic weapons, prompting retaliation from Iran, which launched about 100 drones. And in the markets, airline stocks into Globe Aviation or Indigo and SpiceJet lost between 4 and 1.5% after that Air India plane crash in Ahmedabad on Thursday. Both airline stocks have lost more than 6.5% and 3.5% in two sessions, according to Reuters. And for the week, the Nifty and Nifty lost about 1% each. Meanwhile, uncertainty on the trade deal continues. The US-China trade deal is lacking in details, and the India-US one is still on the burner with no clear deadline in sight, or rather, many deadlines have already passed. Meanwhile, on Wall Street, uncertainty has reduced to the market, which was otherwise ignoring everything else and galloping on. Even as oil prices spiked on Friday, the yield on 10-year treasuries halted a 4-day slide and started rising again. The CBOE volatility index of VIX was above 20. As for stocks, they were relatively subdued until selling pressure hit at the end of the day, sending the S&P 500 down 1.1%, according to CNBC, which added that this still remains about 3% away from the record. Now, back home, the rupee was down below the 86 mark on Friday, hitting a 2-month low thanks to that jump in crude oil prices, which obviously affected sentiment. So the rupee fell about 49 paise to close at 86 rupees 9 paise on the dollar after closing at 85 rupees 60 paise on Thursday, according to Bloomberg. Not surprisingly, the US dollar has rallied on Friday after trading around a 3-year low the previous day as investors moved to safe haven assets, as we just discussed, following those airstrikes, according to CNBC. The dollar index, which measures the greenback against a basket of major peers, was seen slightly higher on Friday, trading around 98.19. And here's a message from a sponsor. Want smarter investing at your fingertips? With InvestingPro, get real-time market data, custom alerts, and global financial insights all in one place. Join 46 million users already making sharper decisions. Download InvestingPro today. More details in the link below. Oil is back. First, the forecasts. Analysts at Goldman Sachs have raised their oil price forecast for the coming months by about $2 to $3 a barrel and laid out scenarios which range from above $100 a barrel in the worst case to below $50 a barrel in the most bearish scenario. Make of that what you will. A note quoted by Bloomberg says that the potential of further escalation in the Middle East implies that the short-term risks to our price forecast are now skewed to the upside, though they still maintain their call for prices to drop below $60 by the fourth quarter of this year, which means that computing on the basis of demand and supply, oil prices are still looking weak at this point. Another report in Bloomberg says that the latest assault by Israel is putting oil traders' nonchalance to the test. Even as there have been no impact on supply so far, the strikes have shaken a market which was otherwise focused on a looming surplus, driving down prices, with the Organization of Petroleum Exporting Countries plus quickly unwinding production cuts and output rising elsewhere from Brazil to Guyana, and of course a trade war that could hit demand. A surge of trading in out-of-the-money call options, says Bloomberg, showed that many were seeking to hedge against the possibility of a price spike. The other worry for the market is a disruption of shipping through the Strait of Hormuz, through which about 1/5 of global oil supply flows, but analysts also say or told Bloomberg that this seemed unlikely. India wants to suspend rare earth exports. India has asked the state-run miner IREL to suspend a 13-year-old agreement on rare earth exports to Japan and to safeguard supplies for domestic needs, according to Reuters, thus reduce India's dependence on China. Now, China is the leader of the critical minerals supply chain. As we've been discussing, it produces roughly 60% of the world's supply of rare earths and processes about 90%, which means that it's importing these materials from other countries and then refining them. IREL also wants to develop India's capacity for rare earth processing, which is dominated globally by China and has become a weapon, as we've seen in the rising trade wars. China has curbed its rare earth materials exports since April, putting pressure on automakers and other high-tech companies worldwide. In a recent meeting with auto and other industry executives, India's Commerce Minister asked IREL to stop its exports of rare earths, mainly neodymium, a key material used in magnets for electric vehicle motors, according to that Reuters report. Under a 2012 agreement, IREL supplies rare earths to Toyotsu Rare Earths India, a unit of Japanese trading house Toyota Tsusho, which processes them for export to Japan, where they're used to make magnets. So this is an interesting supply chain insight, which I guess we would not have known of unless something like this had happened. So in 2024, Toyotsu apparently shipped about 1,000 tons of rare earth materials to Japan, and this is about one-third of the 2,900 tons mined by IREL, though Japan relies mainly on China for the majority of its rare earths needs. So the reason IREL has been exporting rare earths is because of a lack of domestic processing capacity. But following obviously those disruptions to supplies of Chinese materials, it wants to see if we can keep those rare earths at home and expand domestic mining and processing, Reuters said. On the other hand, India may not be able to immediately stop supplies to Japan because they do fall under a bilateral government agreement, and IREL wants this to be amicably decided and negotiated because Japan is a friendly nation, that source told Reuters. Meanwhile, CNBC is reporting that China's dominance of the global rare earth supply chain will not dwindle easily, even if Beijing decides to improve more export licenses through deals with Europe and the United States. 3 Shenzhen-listed Chinese companies this month said Beijing approved their exports of magnets with rare earths, that are metals which are useful for cars, defense, semiconductors, and high-tech products. But another firm said last month the export licenses can be used for only one shipment. So in Europe, automotive industry have said that in the case of magnets and heavy rare earths, long-term export licenses from China were only valid for a maximum of 6 months. This also obviously gives you a sense on where the logjam is, which is procedures. And of course, those procedures did not exist in these forms a few months ago. An economist at Dutch bank ING told CNBC that diversifying away from Chinese sourcing of rare earths is likely to be extremely difficult and at best a limited long-term solution. According to him, Europe, for example, produces no rare earths, and the US has only recently begun small-scale production of neodymium and praseodymium. However, both regions hold only a fraction of global reserves, limiting their ability to scale up. So earlier we had, of course, discussed how China had announced export controls on 7 rare earths in early April, following a series of tighter restrictions in the last 2 years on a broad range of critical minerals. So while the efforts are of restrictions aimed against the United States, because it's happening at the customs end, it's really affecting many more countries, including India. Office space is booming. India's office space market is exploding, the highest in the world and more than the United States. So there are interesting reasons why this is happening, including economic growth and prospects in India. So what are the reasons for India becoming the world's largest office space absorber at this point? I reached out to Anshul Jain, CEO of India, Southeast Asia and APAC Tenant Representation, Singapore, and based out of Singapore. And I began by asking him this precise question.
One is domestic consumption related growth that both Indian companies as well as foreign companies which are servicing the Indian market is on growth path. And the second trend is foreign companies opening their global capability centers and offshoring centers in India to take advantage of the skill base to sort of innovate product and processes across the world. So I think there's a demand side of the story here with those two aspects. There is another part of the story where your question was, India is the largest absorber, and why is that? The second reason also is the demand from some of the biggest countries in the world has gone down post-COVID. So if you think about US, which is the largest office market in the world, post-COVID, it has just not returned to its glory days. And there's actually, in most years, post-COVID, US has been on negative absorption, which means that people are kind of giving up more space than they're taking space. And you think about the other massive engine of growth that the world had was China. and China hasn't been growing as fast as the world has been used to. So you have those two guzzlers of space kind of going down. And you have sort of India, which has really kicked up post-COVID as a result of multiple factors, which has kind of resulted in India being the largest absorber of space at the moment.
Right. And can you give us a sense on what kind of base we're talking about from which we're seeing the kind of growth that we are seeing right now in India versus, let's say, 5 years ago?
Yeah, so if we think about average absorption, an average gross absorption pre-COVID, right? So if I roughly look at 2016 to 2019 numbers, average yearly gross absorption was in the order of, let's say, 50 to 60 million square foot, give or take. And you kind of think about the years 22 to 24, the average yearly absorption has kicked up to 70 to 80 million square foot. In fact, in the year 24 was almost touching 90 million square foot, right? So you think about that average movement, that's almost about 20 million square foot delta, 25 million square foot delta from pre-COVID 3 years to post-COVID 3 years.
And how much would this be a churn? As in, are we saying that 20 million square feet, let's say, is the growth, 50 million to 70 or 70 to 80? Or what is the usual proportion of it, which is, let's say, old office space that's coming back into the market?
No, so this is the demand side I'm talking about, right? And from a demand perspective, there's another barometer we use, which is net absorption. And net absorption really means what's the net new space that is getting absorbed, right? And that's kind of gross absorption minus the churn space, as you call it. So the net absorption also has moved up. So pre-COVID, the net absorption was about 33, 34 million square foot. And the same figure for post-COVID has been about 50 million square foot. So even the net absorption on an average has gone up by 15 to 17 million a year, which represents almost a 30 to 40% increase on net absorption. Now, the reason for that also is that a lot of companies are moving from older space to newer space, right? So there's definitely an element of that. And then there's an element of expansion. So I think when you look at the gross absorption, net absorption, it kind of clears the picture.
And which parts of India are leading this? So you referred to GCCs earlier. Would GCCs be the largest component of this driver, or are they halfway? Where does it stand?
So GCCs are now contributing almost a third of Indian demand. So last year, I think GCCs tapped off at about 25 odd million square foot of the sort of 80 plus or 85 million odd square foot absorbed. So I'd say, just under a third, which is quite significant. And, there were almost sort of 250 new GCCs, which got sort of, formed last year. So that's a significant part of demand coming in. And they basically span across sectors, right? So whether it's for banking sector, whether it's healthcare, pharma, whether it's engineering, manufacturing, research, and so on and so forth. So that clearly is significant from a type of work perspective. From if we look at the industry segments which are growing, whether it's GCC or non-GCC, BFSI, banking and financial sector has really taken a big lead last year. Engineering, manufacturing companies, pharma, healthcare has been another major contributor. And the regular IT BPM still make up about sort of, 30 odd % of the demand. So these are the sectors which are kind of really outshining at the moment.
So you're saying that IT BPM, which is business process management and information technology, the classic way we know it, is still a third of the market, roughly.
Yeah, so it's probably tapering off a bit. It used to be 32, 33%. And it's kind of down to about 27, 28%, but still significant.
Yeah, which I'm just trying to correlate it to, let's say, the perception that, let's say, IT industries have slowed down hiring and some of them are actually in the negative now compared to where they were. And definitely we're not growing, at least in bodies, the way we were growing until about 3 or 4 years ago.
For sure. But you're looking at probably, when you look at these figures, you're looking at the top 5 or top 6 sort of, big IT companies. But, when we look at our figures, they stretch across different sort of segments and smaller players get involved in that as well. So I think there's a small difference there. And plus, when we say IT, BPM, IT also is sort of IT software development and so on and so forth. It's not necessarily just the BPM industry.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.